For much of the 20th century, the U.S. coffee industry was treated less as a strategic sector than as a cultural constant. Coffee was simply there, cheap, abundant, and reliably delivered through a familiar chain of importers, roasters, distributors, and national brands. This reliability bred a quiet complacency. Unlike steel, energy, or semiconductors, coffee was never framed as an industry requiring a long term national strategy. It was a commodity assumed to manage itself. The United States did not grow coffee at scale, but it mastered everything around it: global sourcing relationships, industrial roasting, branding, and retail expansion. American firms dominated value added stages while production risks remained offshore. This division of labor seemed efficient and permanent. As long as ports functioned, shipping lanes stayed open, and consumer demand remained steady, the system appeared self sustaining. Over time, however, maturity hardened into inertia. Large U.S. coffee companies optimized for quarterly returns rather than supply chain resilience. Investment flowed into marketing, store expansion, and financial engineering, while logistics, processing, infrastructure, and long term supplier relationships received less attention. The industry's success narrative, built on brand power and consumer loyalty, masked how thin its structural margins had become. At the same time, fragmentation accelerated. Independent roasters, regional distributors, cafe chains, and multinational conglomerates coexisted without a shared strategic direction. No single actor, public or private, assumed responsibility for safeguarding the industry's competitiveness in North America. Coffee was ubiquitous but institutionally orphaned. This complacency also reflected a broader American habit: assuming leadership endures by default. Because the U.S. had long been the center of gravity for North American coffee consumption and branding, it discounted the possibility that another country could quietly re engineer the industry's backbone. Efficiency was mistaken for permanence, and scale for security. By the time signs of strain became visible, rising costs, supply volatility, logistical bottlenecks, the assumption of inevitability had already failed. The industry America took for granted was no longer insulated by history or habit. It was exposed not by a sudden collapse, but by the realization that others had been planning while it had been coasting. The disruption to the U.S. coffee industry did not arrive with spectacle or confrontation. It came quietly through balance sheets, logistics contracts, and ownership changes that, taken individually, seemed unremarkable. Collectively, they signaled a shift few in the American market had anticipated. Canada was no longer a peripheral player in North American coffee. It was becoming a structural center. Canadian firms moved with a clarity of purpose that contrasted sharply with American complacency. Rather than competing primarily on branding or cafe culture, they focused on control of roasting capacity, distribution networks, and cross border logistics. Investments flowed into modern roasting facilities near ports and rail hubs, allowing Canadian operators to process large volumes efficiently and ship seamlessly into U.S. markets. Geography, once seen as a limitation, became an advantage. This expansion was accelerated by consolidation. Canadian companies acquired regional roasters, private label producers, and logistics firms, knitting together vertically integrated operations. Where the U.S. market remained fragmented, Canada's coffee sector became increasingly coordinated. Scale was not merely financial, it was operational. Costs fell, margins stabilized, and reliability improved at precisely the moment American firms were struggling with inflation, labor shortages, and supply chain disruption. Trade frameworks further reduced friction. Existing U.S. Canada trade agreements made the cross border movement of roasted coffee, equipment, and inputs relatively seamless. While American firms looked outward to global sourcing challenges, Canadian competitors quietly optimized continental trade. The result was speed, faster turnaround times, shorter supply chains, and greater resilience during global shocks. Perhaps most unsettling for U.S. industry leaders was the cultural misreading. Canada's rise did not look like domination in the traditional sense. There were no iconic brands displacing American names overnight. Instead, Canadian companies embedded themselves upstream, supplying retailers, food service operators, and private labels. By the time their influence was widely noticed, dependency had already formed. What shocked the U.S. industry was not that Canada competed, but that it did so methodically, patiently, and without seeking attention. The shock from the North was the realization that dominance can change hands not through disruption alone, but through discipline. Canada's advance would have mattered little if the U.S. coffee industry had not already been weakened from within. The deeper story is not one of external displacement, but of internal erosion, structural vulnerabilities, long ignored because they accumulated slowly and without drama. At the core was fragmentation. The American coffee economy grew as a loose ecosystem rather than a coordinated industry. Multinational giants, regional roasters, specialty brands, and independent cafes operated on parallel tracks, often competing for the same inputs while lacking shared infrastructure or collective leverage. This disunity limited economies of scale in logistics and processing, leaving many firms exposed to cost shocks they could not absorb. Labor intensified these pressures. Rising wages, uneven availability of skilled workers, and high turnover strained roasting plants and distribution centers. Unlike sectors that invested early in automation and centralized processing, much of the U.S. coffee industry relied on aging facilities and labor intensive workflows. Modernization was deferred not because it was unnecessary, but because returns appeared less immediate than brand expansion or retail growth. Cost structures also drifted out of alignment with reality. Transportation expenses climbed, warehousing tightened, and energy prices fluctuated sharply. Yet pricing power remained constrained by fierce competition and consumer sensitivity. Many U.S. firms responded by compressing margins, assuming volatility was temporary. It was not. Thin margins became a permanent condition. Financialization compounded the problem. Private equity and investor pressure emphasized rapid scaling, exit strategies, and short term profitability. This mindset rewarded consolidation without integration and growth without resilience. Balance sheets improved while supply chains hollowed out. Risk was shifted downstream to suppliers, workers, and logistics partners rather than addressed systemically. Perhaps most damaging was the absence of strategic stewardship. No coordinated effort emerged to assess continental competitiveness, infrastructure investment, or long term supply security. Coffee remained categorized as consumer culture rather than industrial capacity. By the time structural weaknesses were widely acknowledged, competitors with tighter integration and lower friction were already positioned to capitalize. The U.S. coffee economy did not collapse, it softened, and in industries shaped by efficiency and reliability, softness is an invitation for others to step in and take over what once seemed unassailable. The weakening of the U.S. coffee industry cannot be understood without examining the quiet role of policy, less through deliberate harm, than through sustained neglect. Coffee occupied an odd space in American economic thinking, essential to daily life, yet absent from strategic trade and industrial planning. This absence carried consequences. Trade agreements between the United States and Canada were designed to reduce friction across a wide range of goods, and in this respect, they worked precisely as intended. Tariffs were low or non existent, customs procedures streamlined, and regulatory alignment sufficient to allow roasted coffee and related inputs to move freely across the border. Yet, while these frameworks enabled efficiency, they also rewarded those who organized themselves to exploit them. Canadian firms did. Many American ones did not. U.S. regulatory complexity added another layer of disadvantage. Food safety compliance, labor regulations, state level environmental rules, and transportation standards varied widely across jurisdictions. For large firms, compliance meant cost. For smaller roasters and distributors, it often meant delay or exit. Canada's more centralized regulatory environment, combined with provincial coordination, offered predictability that appealed to investors and logistics planners alike. Public policy also failed to encourage infrastructure renewal. Ports, rail links, and industrial zones critical to coffee processing and distribution are aging without targeted investment. While public attention focused on high tech manufacturing and strategic minerals, everyday consumer industries were left to fend for themselves. The assumption was that market forces alone would maintain competitiveness. In practice, they favored actors with lower friction and better coordination. Perhaps most consequential was the absence of strategic monitoring. No federal or industry led mechanism consistently evaluated continental shifts in processing capacity, ownership concentration, or supply chain dependence. Canadian firms expanded roasting and distribution capacity within reach of U.S. markets, largely unnoticed by policymakers. When concerns emerged, they were framed as commercial disputes rather than structural shifts. Inattention is rarely neutral. In a deeply integrated market, policy silence functions as a policy choice. By failing to recognize coffee as an industry shaped by trade, architecture, and regulatory asymmetry, the United States allowed comparative advantage to migrate. What followed was not the loss of access, but the loss of leverage. Capital did not merely respond to the shifting geography of the coffee industry, it accelerated it. As margins tightened and volatility increased, investment decisions began to favor structures that promised control, scale, and predictability. In North America, that increasingly meant consolidation, and Canada proved a more accommodating environment for it. Canadian firms and investment groups pursued vertical integration with notable discipline. Roasting, packaging, distribution, and private label production were brought under single corporate umbrellas. This reduced transaction costs and insulated operations from external shocks. Capital flowed toward assets that anchored supply chains rather than toward consumer facing expansion alone. The emphasis was less on visibility than on indispensability. In contrast, much U.S. consolidation was partial and uneven. Acquisitions often preserved legacy operations rather than restructuring them. Private equity prioritized rapid growth and brand aggregation, assuming efficiencies would follow. Frequently, they did not. Disconnected facilities, incompatible systems, and overlapping logistics eroded the very gains consolidation was meant to deliver. Access to patient capital also differed. Canadian pension funds and institutional investors, accustomed to long-term infrastructure-style returns, viewed coffee processing and distribution as stable, cash-generating assets. This perspective encouraged investment in modernization, automation, and capacity expansion. In the United States, the capital was more impatient, exit timelines were shortened, and cost cutting replaced reinvestment. Ownership patterns shifted accordingly. American retailers, food service operators, and even national brands increasingly relied on Canadian owned or Canadian based processors for private label and bulk supply. These relationships were efficient and therefore invisible to consumers, but efficiency masked dependency. Control migrated upstream, away from storefronts, and into facilities that determined pricing, volume, and reliability. Consolidation itself was not the problem. It was the uneven quality of consolidation. Where capital was deployed to integrate and harden supply chains, it produced resilience. Where it was deployed to extract value without rebuilding systems, it produced fragility. Over time, capital followed results. The coffee industry's center of gravity shifted not because money fled the United States, but because it found greater structural coherence elsewhere. Capital, indifferent to sentiment or tradition, simply aligned with those who treated the industry as a system rather than a collection of brands. Few industries illustrate the gap between image and infrastructure as clearly as coffee. In the United States, coffee evolved into a powerful cultural symbol of creativity, productivity, identity, and lifestyle. Cafes became social spaces, brands became personal statements, and origin stories became marketing currency. This cultural sophistication, however, increasingly distracted from the industrial foundations that made it possible. American coffee companies invested heavily in narrative, sustainability language, aesthetic design, and experiential retail multiplied. These efforts resonated with consumers, but they did not strengthen logistics networks, modernize roasting plants, or secure long term processing capacity. The industry came to equate cultural relevance with competitive strength, mistaking visibility for control. Canada pursued a different path. Cultural signaling mattered less than operational reliability. Investments were directed toward throughput, consistency, and cost discipline, while U.S. firms refined brand identities and seasonal offerings. Canadian operators refined shipping schedules, inventory management, and production efficiency. One approach generated attention, the other generated leverage. This divergence produced a subtle but decisive imbalance. American brands, even successful ones, often depended on external processors and distributors to fulfill demand at scale. As Canadian firms expanded upstream control, they became the silent enablers of U.S. coffee culture. The relationship appeared symbiotic, but it was asymmetrical. Culture traveled downstream, control moved upstream. The emphasis on branding also shaped managerial priorities. Leadership talent was often drawn from marketing, retail, or design backgrounds rather than logistics or industrial operations. Strategic discussions centered on consumer engagement metrics rather than continental supply resilience. When disruptions occurred, whether from shipping delays, labor shortages, or cost spikes, responses were reactive, not structural. Cultural branding is not frivolous. It creates demand, loyalty, and meaning. But without industrial investment, it rests on borrowed stability. The U.S. coffee industry discovered that a compelling story cannot substitute for owned capacity. The Canadian model did not reject culture, it subordinated it to infrastructure. In the long run, the industry rewarded those who treated coffee less as an identity and more as a system. The lesson was not that branding failed, but that branding without industrial reality left American firms exposed to those who quietly built the machinery behind the cup. The consequences of this shift are already embedded in the structure of the North American coffee market. For U.S. producers and roasters, margins are tighter and strategic autonomy reduced. Decisions once made domestically about pricing, volume, and fulfillment are increasingly shaped by upstream partners whose priorities are not necessarily aligned with American industry resilience. Dependence, once invisible, has become a defining condition. Workers feel the effects unevenly. Some benefit from stability within larger integrated supply chains, while others face plant closures, outsourcing, or consolidation driven layoffs. Regional roasting hubs that once anchored local economies have thinned. The geography of coffee work has shifted northward, following capital and infrastructure rather than consumer demand. Consumers, for now, experience little disruption. Shelves remain stocked, cafes remain open, and branding continues to signal abundance. Yet this continuity conceals fragility. Fewer nodes control more of the system. When shocks occur, whether from trade disputes, transportation failures, or global supply interruptions, the consequences will travel faster and farther than before. The road ahead is not foreclosed, but it requires a change in orientation. Recovery does not depend on reclaiming cultural leadership, it depends on rebuilding industrial seriousness. That means reinvesting in modern processing facilities, logistics, coordination, and long term supplier relationships. It means recognizing coffee as a strategic consumer industry shaped by trade architecture, not merely by taste. Policy has a role, but not a dramatic one. Predictable regulation, infrastructure renewal, and strategic monitoring would reduce friction without distorting markets. Industry leadership must follow. Fragmentation cannot be solved by branding, nor can resilience be outsourced indefinitely. Canada's dominance did not emerge from hostility or advantage alone. It emerged from attention. The U.S. coffee industry's crisis is therefore less a story of loss than of neglect. The lesson is sober but actionable. Industries do not remain competitive because they are beloved or familiar. They remain competitive because someone is watching the system as a whole and tending to it before weakness becomes dependent. The future of American coffee will be decided not by sentiment, but by whether it relearns the discipline it once assumed it no longer needed.